specific segment within that Lincoln market.
Got it. Okay, so let's pivot to optimizing income. This is where investors can really make a difference, yeah? How do you actually do that for a place like 1621 G Street?
Right. So income optimization, fundamentally, it's about closing that gap between what units are renting for, the below market ones, and what they could be renting for. The strategy guide lays out a few core ways. First, aggressive marketing. Think beyond just listings, maybe targeted ads, local outreach. Second, you could offer incentives, maybe a month free, maybe small upgrades for signing a lease at the higher rate. And third, the big one often is physical renovation. The estimate here is about $8,000 to $12,000 per unit to really justify pushing those rents up.
Okay, 8 to 12 grand per unit for renos. So applying that potential, how much room is there actually to grow the income at 1621 G Street right now? What do the financials show?
Well, if you look at the unit mix report and the rent roll in that proposal, the property's current actual total scheduled income annually is $82,206. But the market total, what those units should be getting based on the market, is $87,600.
Ah, so that's a $5,340 difference right there.
Yeah, exactly. That's the immediate potential upside.
Yeah.
For an investor, that's not just waiting for the market. That's, forced appreciation you can create yourself through management.
Okay, let's quickly define a few key terms from these reports. They pop up a lot and give you that financial pulse check.
Good idea. First, DSCR, debt service coverage ratio. Super important for banks. It basically measures if the property's income can cover its mortgage payments. For this property, it's currently 1.05. The proposal calls that tight.
Tight meaning barely covering it.
Yeah, pretty much. But the key thing is banks usually underwrite based on projections for the first full year. So it shows why optimizing that income quickly is critical to make the numbers work better for financing.
Got it. Okay, what about cap rate?
Right. Capitalization rate. Think of it as a quick measure of potential return. You take the net operating income, or NOI, and divide it by the property's value or price. Here, the current cap rate is 6.37%. The market cap rate is listed as 7.14%.
So it's a bit lower than the market average. What does that usually imply?
It could mean a couple of things. Maybe there's room to increase the income and therefore the value to match the market rate. Or perhaps it's currently valued a bit higher relative to its income compared to similar properties. Makes getting those rents up even more important.
Makes sense. And GRM, gross rent multiplier.
Another valuation tool, simpler calculation. Just divide the property price by the total annual rent it brings in. This property's GRM is 9.35, while the market's is 8.71. Just another way to compare value. And you mentioned pro forma. That's just a fancy term for those financial projections we talked about there.
Yeah.
What if we do this plan? Oh, and CCIM. You saw that with Jim Sanderson's name. That's Certified Commercial Investment Member. It's a pretty respected designation for commercial real estate pros. Means they know their stuff.
Okay, so pulling this all together, even though the starting financials, like that DSCR, look a bit tight for 1621 G Street, the backdrop is this really strong Lincoln market. Low vacancy, good rent growth, not a ton of new competition coming online.
Right. It creates a really favorable environment, sort of a runway, for those income optimization strategies to actually work and unlock value pretty quickly.
It definitely paints a picture of potential. Yeah, clear path to improvement.